The Big Picture with Hiren Ved, Director and CIO at Alchemy Capital Management. Hiren, so good having you in the studio right now.
Thank you.
And like Neeraj said, it's time to grill you now. What is it looking like, the market? Greece somewhat seems to be a done deal. US Fed rate hike, a big question mark there, and earnings to deal with. What's the picture looking like? I mean, does it seem like we have snapped out of that trading range that we were in? Is it good times ahead? Now is it going to be a climb back all the way back to a 9200? What's the picture looking like?
So I think first, let's just step back and see essentially, I think we are in a very different scenario pre-global financial crisis and post-global financial crisis. I think the pre-global financial crisis we had leverage going up, so we had solid growth for corporates, we had volume and value growth both happening. We are now in a world where growth is a big challenge across the globe, right? So because we are in a deleveraging process, and instead of in an inflation, we are in a deflationary process. So it's very difficult to get price growth. And therefore, I think you need to now focus on companies which have the ability to either tap into new markets or are able to capture the same markets more efficiently, and productivity and innovation is going to be the name of the game. Because you don't have the tailwinds of global growth with you, and you have a deflationary process. If you look at in India, also I think if you compare India to, let's say, a corporate balance sheet, what has happened is that the balance sheet has improved, but the P&L is yet to pick up. I think we are seeing early signs of the pickup in P&L. As far as relating that to the markets is concerned, I think that after the first year of the new government, I think that expectations were a bit ahead of what the reality was. And it's taken time for things to change on the ground. I believe that what has happened now is that expectations have come down, right? And I think that's very important. It's not reality versus what happened, but it's expectations versus where you are in the markets. So I think the expectations are now more muted, and especially after the fourth quarter numbers, people have been a little more realistic that it's going to take time. It's not a V-shaped recovery, it's a long U-shaped recovery in India. So my sense is that we are base building before the next phase of leg up in the Indian markets. I have no doubt that after this phase of consolidation, which might last maybe for another quarter or two, we should be headed towards a new high in the Indian markets.
And you see that happening in this calendar year itself?
Well, I don't know, I mean, whether in this calendar year, but certainly in this fiscal year.
So, which means Nifty will trade above 9,000?
I think so.
What will take Nifty above 9,000? Because there are two ways prices go up. P expansion or earning expansion.
Right.
I doubt that P expansion will happen, because P expansion may not happen because the good quality companies are already trading at lofty P multiples. Earning expansion, and I don't see signs of visible earnings recovery.
So you're right that we've not yet seen an earnings recovery so far, and there are several reasons for that. One is that demand conditions are still pretty soft, but more importantly, we've seen some short to medium term factors which have not allowed earnings to go up, i.e. we've seen a very steep fall in commodity prices. So most companies are probably taking inventory hits on in the fourth quarter, and probably some of that will fly into the first quarter as well. Secondly, the government cut back expenditure very aggressively in the fourth quarter of fiscal last year, which is typically the biggest quarter for corporate India. And because they had promised that they would be at 4.1% fiscal deficit, they cut back very aggressively. Now, with indirect tax revenues up 30%, the fiscal deficit well in target, the current account well under control, the government has some space to expand expenditure, and that's what happened. If you see the first few months of the new fiscal year, the government has started to spend money, and because the private corporate sector is not yet spending money, because those whose balance sheets are ravaged will take some time to deleverage. The clean balance sheets, capacity utilization is still at 55-60%. Unless that goes to 80-90%, they won't spend on a new plant or a new project, right? So I think therefore the government has to step in. And that's why in the fourth quarter, government spending was reined in. You had a drastic fall in commodity prices, and therefore you had that deflationary impact. You had a currency movement. The euro declined by 12% in the first quarter. So all of these impacts did not allow earnings to grow, right? So it's going to take time. I think the second half of the year is when you should start seeing earnings begin to grow.
And I think Arun Jaitley reiterated something to that effect today in the papers as well, that government spending will pick up dramatically in the second quarter. So I think we'll watch out for that as well. But so in light of this market view that you have, Hiren, let's talk about your, how are you investing right now? Your market mantra, as I read it, is that you believe that people should buy quality and growth at a reasonable price. My question is quality in the current market scenario available at a reasonable price?
It is not, let's be real.
Well, yes and no, in the sense that if you keep looking at the traditional areas where quality has been, obviously prices have been well bid up there, and people have focused a lot on visibility and quality, and that's where all the money has flown. But I think eventually that will change, because that is happening because the economy was not turning around, right? And so people were reluctant to look elsewhere. I think in every new bull market, there are always new sectors, new leaders will emerge, right? And I think that it's not very apparent to the eye, but it happens slowly and steadily over a period of time. And I think that you will see new leaders emerge. I'm not saying that the erstwhile quality companies will not do well. It's just that from a market perspective, valuations there are probably already pricing in a good fundamental story. So I think you have to look at new areas where you think that incremental change is going to happen.
And the one new area you like is defense manufacturing. Tell me, why are you so excited about investing in companies which have a presence in defense manufacturing? A, India is not competitive. B, defense manufacturing, before it translates into an earnings reality for Indian companies which are in the manufacturing or the defense manufacturing sector, it could take 2 years, it could take 3 years, it could take 5 years, it could take 7 years.
You're right, Nikunj, in the sense that this is not a 1 year story. It is clearly a 5 to 10 year story, or even more, right? Why it is attractive is because we've realized we are one of the biggest buyers of defense equipment globally, at $15 billion a year, right? Clearly, there are certain areas in defense where Indian companies do have the ability to manufacture. You have some of the best forging companies in the world. You have the best machining companies in the world. We have seen in the electrical sector where Indian companies, and including MNCs, have used India as a global sourcing base. I think that this is a trend which is likely to be a significant trend going into the future, because the big OEMs, the Airbuses, the Boeings, the Lockheed Martins of the world are wanting to sell products to India. And if they want to sustainably do business in India, they will have to start manufacturing in India. And secondly, I think Indian companies will become part of global supply chains. Now, the question is that, is it going to happen overnight? Can we see that in earnings tomorrow? It's not going to happen. Maybe some companies are ahead of the curve. Some companies are just beginning to position themselves to take advantage of this opportunity. It's a multi-year opportunity. It's not going to happen overnight. But it's clearly an area where you're not talking about creating new demand. The demand already exists. It's just that some of that demand has to start looking inwards, right? And then these businesses will have a big opportunity.
Okay, so let's talk with one such company who could be a case in point for the aerospace business when it comes to the entire Make in India theme. And considering the aerospace business provides a large global opportunity for Make in India, global tier 1 status with reputed OEMs like an Airbus, Boeing, Bell Aerospace, there is one such company wherein the order book size is pretty hefty, and the new aerospace order execution is going to begin from the Q2 itself. Let's chat with one such company then. Udyant Malhotra from Dynamatic Technologies. The MD and CEO of the company joins us on the show right now. Udyan, pleasure having you. We have Hiren with us from Alchemy Capital right here in the studios, and he's of the belief that if you want to bet big on one sector, that's got to be the one that you have presence in. So tell us a little bit more about how big the opportunity is, considering the government's thrust on Make in India for companies like you, Dynamatic Technologies.
Okay, thank you. Firstly, good morning. There are a couple of opportunities. One is, of course, the government's thrust, but I would actually expand on the thrust being the thrust at the right time. The world is increasingly more insecure. There's war all over the world, and there's also economic expansion that's taking place in the East. So as you see, countries like India, we are expanding in our neighborhood around us. We don't have the most secure friends around us. So you have a confluence of economics and a need for security. And I think that is what we're really talking about. An opportunity that is based on our timing, this century, this generation. And then immediately this government focusing on Make in India as against just import stuff or make it in public sector units. So I think you'll see a lot more indigenization. I think you'll see a lot more private sector participation. I think you'll see a greater modernization of the public sector and partnerships between the private sector and public sector in aerospace and defense. And I think over time you'll see Indian companies becoming really good at what they do, and instead of us just being import substitutes in our businesses, we will also be exporting and accessing global markets with a very strong home market.
Hiren, so we've understood the big picture. We've understood that defense manufacturing is the space to go. But if you have to ask a tough question to the management of Dynamatic Technologies, Hiren, what would be your question, Hiren?
So, hi Udyant, good morning. Essentially, we all know that there is a significant opportunity, and if the opportunity is so big, we are going to see several large business groups in India also trying to capture that opportunity. What, in your mind, are the differentiators or competitive advantages that a company should have to be able to successfully exploit this opportunity that is available in front of us? And what will differentiate one company from the other? Or competitive advantages that a company should have to be able to successfully exploit this opportunity that is available in front of us? And what will differentiate one company from the other?
So I think that defense manufacturing or aerospace manufacturing in particular are very difficult industries. And they're not just industries that land, building, capital will bring you success. It is a game of skill. It's a game of of industrial engineering capability. And I think what will differentiate companies that do well and don't do well, not for the lack of trying. People will try. There's a great euphoria. But the ones that will do really well will be the ones that really have a focus on high quality manufacturing, very artisanal skill building amongst the blue collar workforce, and innovation in the way they apply these products, let's say, to our theater, our market, our home market, and also how they serve customers worldwide. You have to be cost competitive. There's no lottery in any business. So I'll come back to Dynamatic. I mean, if you allow me, I'll just give an example. We've been doing this for now 20 years. We started as a partner with DRDO in development of airframe structures. We became a partner, developmental partner for HAL. And this was our first decade. In the last decade, for the last 8-10 years, we've been working as a partner with global MNCs in building value, in creating world-class products at price points that are attractive for them. And so the advantage is that you can build a price model out of India, you can build an engineering model out of India, and you can build a market model out of India, because India is also a great market. What we focused on was an export market where we worked on really giving value to the customers, taking products that were designed 20 years ago or 15 years ago, and they need to indigenize or they need to globalize these things with digital engineering. So we digitized the stuff, we worked with our customers, engineers, and so you have better products now which fit together better, and also they are cost competitive.
Udin, I think Hiren has another follow-up question.
So Udin, you've been, Dynamatics has been in the business, in the engineering business. You started with hydraulics, you've done auto components, and now you're looking at the aerospace manufacturing capability. If you were to kind of say in terms of a return on capital employed profile of the three businesses, would you say that on a sustainable basis, aerospace can be a high margin, high return on capital business, and can you, what you do at 50 million, can you do the same thing at 500 million at similarly attractive return on capital profile numbers?
Okay, so that's a great question. I would say that our personal experience is that aerospace has higher margins than automotive or hydraulic businesses. However, when you are operating at a smaller scale, your base cost of infrastructure will be higher, and therefore your ROCE will actually increase and improve with scale, even if you're able to drop your margins a little bit. So what I'm trying to say is there's a base minimum that is required for an aerospace or defense business in terms of infrastructure, and that burden on ROC is much higher in a smaller business. So while your margins are really high, we're in from our personal perspective, we're in a sweet spot now, because as we expand into the future, we will find ROCs improving even if we are able to give a better price point to the customer. Because what happens is the initial phase that we've focused on building over a decade of globalization of aerospace out of India, the base costs are embedded into the initial business.
So that takes care of the ROC.
I think you'll have better businesses with scale.
Right. That takes care of the ROC argument. Hiren, anything else that you would want to find out from him?
No, that's fine.
Okay, so broadly the two questions answered. Just one final question from my side, Udayant. I mean, whenever we speak to investors, our Twitter accounts, when they speak about defense, the aerospace business sounds very sexy. I mean, people just want to look at companies which are doing this. My question is, what kind of revenue potential does this hold for Dynamatic, the consolidated entity, over the course of the next couple of years? Your ROCs will be great, your ROE will be great. What about the revenue run rate?
Yeah, great. See, listen, we look at our business as an engineering business. We look at ourselves as a composite manufacturer of highly engineered products. The aerospace business has the richest margins, and we are increasing our shares. It's like the creamier the milk, the better it gets, and that's what we're focusing on. If you look at our business, if you just look at the public information about our company, you'll see that we have unprecedented orders. We have a tail behind us of execution on time with zero defect. So we're very clear, in the next 6 months we're ramping up the 3 largest programs in India in aerospace amongst all companies. The largest Boeing contract to date is currently being ramped up by us. The largest Airbus contract in India to date is being ramped up by us right now, and the largest program of Bell helicopter in India is being ramped up. So we have the 3 largest programs ramping up right now in Dynamatic. So this is public information. I won't go into numbers, but I'm just saying the history is just a pointer in terms of skill building. The future is much bigger in terms of operations and volumes and, of course, value.
Hiren, are you convinced about the management and the commentary?
Well, yeah, I mean, we've been following the stock for the last 10 years. So
10 years?
Yeah, I mean, they've been pretty early in this game, and I think that they're fairly well positioned. But as I said, it's not a story of tomorrow. It's going to unfold over the next 5 to 10 years. So people have to be very patient. But you know, if you're patient, then the rewards
can be disproportionate as well.
Will be disproportionate.
Okay, we'll talk about
well, look at how patience is paid just today. So, Udyan, let me congratulate you, not just Hiren, but it seems like our viewers as well were very convinced. A quiet start, and now your stock is holding up in excess of 6% in last count. Let's just bring up that stock price very quickly on your screens. Udyan, thanks once again for taking time out and speaking with us today. There you go, 6% notch up, and it was holding up by about almost 6.25% at the peak. Where's the stock right now? 31.83. Good to chat with you, Udyan.
Thank you very much.
And we hope that we get to speak with you once your numbers as well come out. Okay, that's the view then coming in from Dynamatic Technologies. But Hiren, you know, just to get back to the point that you were making, you identified this company 10 years back. Let's go back to the drawing board. How do you identify such companies at such a nascent stage?
It was quite interesting. I mean, when we first looked at Dynamatic, it was essentially for the automotive business, because 10 years ago
they were not in aerospace.
I mean, they were, but it was in a small garage. They were doing a little bit for HAL and DRDO, but it was his, you know, one thing that I took away when we first met Dynamatics was his passion for this business, and I think there was this early passion, and we believed that eventually any country who becomes big geopolitically, and I think that, you know, we are a $2 trillion economy today. We have an X spending on defense as a percentage of GDP. As we become one of the big players on the global stage, one of the things is that you need to have a very solid defense capabilities to project yourself as a geopolitical power. And no country has become that big without having a flourishing domestic manufacturing base for defense, right? So obviously this was going to be one of those areas. We didn't know when and how it would scale. So obviously initially what we liked was the engineering capabilities, the kind of stuff that they had done in a small market like hydraulics, where you know, they were global leaders in the hydraulic pumps, and then they moved on to automotive. And obviously this business was very interesting because it was small, it had large capability to grow, margins are much better, and that is why from an investor perspective you always get excited if you are able to identify a business where a company can scale, where the return on capital and the margin profile is far better than what the existing business is doing.
What makes a great investor is not just one idea. So I'm just going to flag off some of the previous profitable ideas which Alchemy as a firm and Hiren Ved as a money manager has identified, and some of our viewers are really testimony to some of the great ideas. He's discussed some of them in the past. Bajaj Finance as a firm, as an investor, Hiren Ved identified this one when the market capitalization was only $400 million. Now zeros have got added. It's more than $5 billion there. Bought Ttk Prestige at 600, sold it when the stock was at 3,500. Tata Motor DVR closer to 80 rupees and sold it north of 340 rupees. Tata Motor DVR.
One change. We haven't sold Tata Motors DVR.
We're still holding it.
Yeah.
But maybe it's a good time to buy into Tata Motors once again, because there is enough and more pessimism about what could go wrong in China. There is enough and more stories have been written out that they've lost the China bet. Our market's undermining the brand importance of JLR and the fact that now the CV business for Tata Motors could also come back. We like Leyland, but we tend to ignore the big boy, which is still Tata Motors in the CV sector.
Sure. No, I think I think that there were fears about the JLR business. I think that the transition in China from a direct business to a joint venture business has taken some time, and there have been some short-term disruptions as a result of that. But you have to understand that probably this is one of the few global brands which has come back with a bang post the global financial crisis. And it's not going to be easy now in a hyper-competitive business like automotive globally to create a new brand like Jaguar Land Rover. I mean, these kind of brands don't get created overnight. You know, it takes time. Personally, if you look at the big luxury brands like a BMW or an Audi or a Mercedes, I think Jaguar is still a very small brand, and there is significant opportunity for it to grow. It has a certain following. The products are brilliant, you know, and I think that they've just about scratched the potential. They're just 500,000, you know, 480,000 JLRs is what they sell globally. You know, can you envisage this company doing 750,000 to 1 million Jaguars over the next few years?
Sure.
I think so. I think the concerns of the market on China were legitimate, but I think that's now already factored in the price. I mean, the stock is already corrected from a peak of 600 to 400, right?
It is at a 52-week low. Let's
Exactly.
be real here.
So I think that probably the pessimism on China could be overdone. We believe that in the next 1 or 2 quarters, as the XC launch ramps up and as the production from China JV starts to stabilize and move up, people will get more reassured from where we are. And I think this is the only nifty stock which is available on a single-digit P, right? So
And such stunning cars.
And such stunning cars, yes.
Yeah.
You can't blame them for the product for sure. We are in conversation with Hiren, who is giving us his big picture idea, his big picture view on the markets, on themes, on sectors, and we've discussed a couple. I think Dynamatic, Hiren, was a good mix of defense, engineering, and a few other things. Now, I look at some other things that you like, and consumption and textiles. Now, textiles, understandably so. I think the markets are rewarding these stocks. They are trading at new highs, and the business is looking okay. But consumption, it's a broad basket. What within consumption and why?
So I think, you know, the consumer markets in India will always be very, very attractive. We shouldn't forget that 55-60% of our GDP comes from consumption in India, right? And India is a pretty unique market. So you know, it's not one homogeneous market; it's an heterogeneous market. So there are many small mini markets within one large market. And what we are seeing is that various categories are exploding as income levels are rising, right? So I believe you mentioned textiles, and I must mention that it's more garmenting today, right? Which is, if you are in the branded garment segment, then I think that is where the big opportunity is, because incomes are rising and now people want to, you know, are aspiring to buy better fashion. They're changing much quicker their wardrobe, and that's where the big opportunity lies.
So you don't like, sorry, just to interject, you don't like the terry towel and the bed linen exporting companies at all?
No, they will do well as well. I think I think there is a clear trend that we are seeing that you know, the textile businesses are coming back after a long time. I'm not too sure whether the current economics is something that will sustain. We will have to watch and see. What's happening in the textile businesses is that most of the companies have started to stop doing capex, right? And therefore they are starting to generate free cash flow. One of the problems of the traditional textile businesses, why they never got high Ps, was the spinners and the weavers, etc. It used to be very capital intensive. They lived on subsidized loans from the government, and ideally they were continuously in a capex mode. So there was never a free cash flow. I think what's happening in some of those businesses is that, at least in the short to medium term, it looks like that they don't want to spend more money on capital expenditure. So therefore they're seeing free cash flows. Now, whether that sustains, or, you know, whether after a few good years of profits they will start to, you know, again start being capital intensive, we don't know. Garmenting is an area which is low capital intensive, more skill intensive, and I think there is and they have a pricing power. The domestic market is significantly big, and also there is a large export market, because all the big brands are starting to source from manufacturers in India. So, there are the twin engines of growth. There's a large domestic market and there is an export market as well. So that's what makes some of these names pretty attractive in the sector. Coming to consumer markets, I think the time has come to look at certain segments. So you have to segment, you have to look at certain categories which you think will become big over the next few years, right? So you rightly mentioned that consumer is a very wide term, and like for example, what happens is that typically when the per capita of a country goes beyond $1,000 or $1,500, there's more money left for discretionary consumption than buying the basic stuff like staples and food, etc., which is the bare minimum that somebody requires. And that's how categories start blowing out. So you've seen, home appliances, for example, kitchenware. You're now seeing, housing products. So all these get into the realm of discretionary consumption.
You've given me a cue, kitchenware.
More Jaguars also. Okay, but yeah, talking about that, I'm going to bring on board Mr. T.T. Jagannathan, Chairman at Ttk Prestige. He joins us on the phone line from Bangalore to chat about exactly that, whether or not things are picking up on ground after a few of slumpish quarters. Mr. Jagannathan, thanks so much for taking the time out and speaking with us. Now, demand had been a little sluggish in the past for you. Are you seeing any signs of a pickup in discretionary spend, because you do expect exports contribution to be higher in the future? Is that really kickstarting now?
Yes, we are seeing an improvement in demand, especially in June and July. April, May was not very good, but June, July there has been an improvement in demand.
Do you expect export contribution to be higher in the future, Mr. Jagannathan?
Yes, the first 2 quarters export was very dismal because of phasing issues. The last 2 quarters will make up what we lost in the first 2 quarters.
Right. What are your plans in the e-commerce space? How are you planning to sell your brands, your products online?
We've tied up with both Flipkart and Snapdeal, and we'll be selling through them.
Okay.
Mr. Jagannathan, Hiren here. Basically, I wanted to ask you a question about Ttk Healthcare, which is an interesting company within your group. We've been growing at 14-15%. You are in certain interesting categories. Do you see growth picking up beyond this 15-16% as you move into some of these under-penetrated categories in Ttk Healthcare?
I think we should repeat. We should be in this 15 to 20% range.
Parts. What parts, Mr. Jagannathan, will drive growth? Can you give us a flavor of that?
Specifically, foods and consumer products.
Wow. And what are the expectations from the Jaipur commercial plant? If you can give me a flavor of that as well.
In what way are expectation? I expect the plant to work well. I expect to produce lots of fry. We will be doubling our foods capacity. Right now we are producing about 350 tons a month. It will be doubled to about 700 tons a month. And margins will improve in foods.
To how much then, Mr. Jagannathan? Can we look beyond a range of 7 to 9%?
Again, it's a company with 7 divisions. Each division has different margin structure. So I'll have to give you a whole table again.
Oh, okay, Mr. Jagannathan, appreciate your time and thank you for joining us. Hiren, you've liked Ttk Prestige in the past. It was at a different curve. It was the cusp of at a strong growth. But right now it's Ttk Healthcare. It's a niche company. They are present in healthcare segment. They are present in food categories, contract manufacturing. So can Ttk Healthcare do what Ttk Prestige did?
It can. I think that they are in interesting markets. They were one of the largest manufacturers, contract manufacturers of condoms. They had a joint venture with Reckitt going a couple of years ago. Now they've come on their own with their own brand, and in a very short period of time they've got a 7-8% market share. Unfortunately, in the last 12 months, there was a diktat by the health ministry that there would be a price cap. Fortunately, just a few days ago, the High Court has ruled in favor of the players in this industry, and the price cap has been removed, because frankly speaking, it's more of a consumer product now. And we think that, you know, there is a large addressable market in India. It's very complex to manufacture, these products. The quality has to be pretty good. They have worked for some of the best brands in the world. So we believe that that's an interesting category. Food is another very interesting category within the consumption. For example, I believe that food penetration in India is still very, very low. And I think that's a big growth area for most FMCG companies that are there. TTK has a unique capabilities. They don't yet have consumer brands, but they're more a B2B business right now. So they are basically growing by doing contract manufacturing for other branded companies.
So Ttk Healthcare is doing that, you're saying?
Yes. So I mean, they have multiple divisions, but they had retained one of the top consulting firms to lay out a plan of growth and vision for the next 5 years to focus on a few areas. And I think that over a period of time, this company could be a very interesting company, going forward, because they are in very interesting categories. And we know TTK, I mean, everybody knows the capabilities of the management. Yes. They're very good at consumer brands. They're very good at distribution. So I see no reason why what they did in Ttk Prestige, they probably cannot do it in Ttk Healthcare.
That's great insight. Most of us weren't even aware about this. So who does Hiren look up to when you need insight, when you get stuck with an investment idea? Who's your mentor, your guru for investment?
Or as a bouncing board, for that matter?
Yeah.
Well, I think, along my career, I've had several gurus. I started my career with KR Choksi and Company. So Kisan Choksi, Mr. Kisan Choksi was a great place and a person who had... who was a value investor, typical old type, used to do a lot of legwork himself. That's where I learned how to go to AGMs and, do plant visits and actually what they call kicking the tires, right? Obviously then our mentor, Mr. Jhunjhunwala, he's been a great inspiration. I think he needs no introduction. What is unique about him is that he's so clearly able. He's one part value investor like Warren Buffett, one part a trader like Soros,
which is very
right?
unique.
Which is very unique, because either you are a good trader or you are a good investor. He's both rolled into one.
So you like to learn the trading from him or the investing from him?
Well, I'm not a great trader, so I would say that there's a lot to learn from him. In terms of how he's been contrarian, he's so focused on managing his risk, and especially when the odds are in his favor, he bets big, and I think that's the way investments have to be made. And he thinks very differently. Thinks differently from the crowd. So I think, and no doubt about that, and that's why where he is.
And of course, the elusive Radhakishan Damani. We all know about him, but no one knows that how he does it, what he does.
Well, it's like, have you heard the story of Eklavya? You have to be like that, right? I mean, he's a different kind of personality, but again, a very successful investor, very insightful. What's most important is that it's pure common sense. I mean, there's no grand theories, no grand quantitative models, but I think very innate understanding of businesses and simple common sense, and that's what has made him a very, very unique investor.
I've been told that he hardly reads, he hardly writes. He is not even a graduate, and yet one of the finest investor. And he doesn't know how to open a BlackBerry. He never uses an Excel, but his numbers are always right.
Yeah, some people, as he said, just have that innate ability to do that.
But your favorite book is actually a book, Reminiscences of a Stock Operator. That's for traders. You call yourself an investor, your favorite book is
Which is exactly what he said. He's not good at it, so he's reading up on it.
No, I think what happens is that when you come to the stock markets, like everybody else, you think you want the next big idea. You start with trading, then soon you realize that only 99%, only 1% of the people who trade make money, right? But I think it was a great learning experience and eye-opener to read Reminiscence of a Stock Operator. I think it's like, it reads like a novel, but there's a lot of great gems and philosophy. It's exactly when you read it, you know that you've gone through the same things in the market, only the context is different, right? So you learn the basic principles over there, and then over time, I think each investor has to find his own style and his own calling. And I think the big money, if you see, has always been made by investors. You look at the most successful investors, over time, you know, the big money is not made in trading. The big money is made in investments.
Okay, on that note, so good having you, Hiren. And, you know, this discussion has, I'm sure, all of us wanting for more. So we look forward to getting you more big picture ideas from you over the course of the year as well.
Sure.
But thank you so much for this time today.
And just a disclaimer, all the stocks that I talked about,
Don't worry, Hiren.
all the stocks that we talked
The screen
about.
has done the job.
The screen has done the job for you.
Yeah.
We've run your disclaimer all through the discussion as well.
Thank you. Thank you so much.
Thank you so much, Hiren.